Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Today, Mark Sipos, the director of the LFG Tax Division, is going to help me share some strategies that can help both your charity as well as your bottom line. Mark, what's the first thing you want to go over?
The first strategy is called a donor advised fund. This allows you to take a large tax deduction when initially funding it and create a charitable gifting legacy for the future. You can contribute up to 60% of your adjusted gross income in cash or up to 30% of your appreciated securities that are held long-term.
The second strategy that can help benefit a charity and your own finances is a qualified charitable distribution, or QCD.
Yeah, QCD can be a great option for those 70 and a half or older. This allows you to contribute money directly from your IRA to your preferred charity. And you're allowed to gift up to $100,000 per year.
And the really nice thing about this is that it can reduce your AGI, which effectively can help things like your Medicare premium, Social Security, various other tax credits and deductions. This should also help people lower their income taxes if they're in retirement and have to take distributions if they're over age 72.
And last spring, the CARES Act allowed a new charitable deduction as well for above the line filers that don't itemize. That's up to $300 per person or $600 if you're married filing jointly.
What about those people that do itemize, Mark?
Well, for those people, typically they're allowed to deduct up to 60% of their adjusted gross income as a charitable deduction when giving cash donations. But for 2021, you can make election on your Schedule A and include up to 100% of your adjusted gross income.
And the nice thing about this is it makes other strategies possible too, because you can look at a traditional IRA and a conversion to a Roth and then offset the tax effect through a contribution to the charity.
Yeah, if you don't qualify to use that QCD we spoke about, you can take money directly out of your IRA, claim it as income, and get the tax deduction of the gift to the charity to write that off.
But if this doesn't make sense to you, you could also gift appreciated securities.
Yes, in fact, you can deduct the fair market value of your appreciated securities as a donation up to 30% of your adjusted gross income. You don't pay any capital gains tax, and you potentially can save on net investment taxes as well.
You can also consider funding charitable remainder trusts, which can help provide a steady stream of lifetime income during your retirement that will also help a charity in the end. So these are all great strategies that can be beneficial to you, your family, and your favorite charity. But these can be complex strategies and require experienced, qualified professionals to help execute them properly. So if you need help with wealth and tax planning, give us a call. We're here to help. Stay tuned for Chris Wallace.